our senior financial analyst,
Our old man of the market.
our dong of the Dow.
Nice.
Okay, you guys, we need to do a recap. And the topic is GME. What happened to you guys?
Same thing that
I'd like to
always
start
happens.
off, but I'd like to start by saying, "Hey, what happened?"
Hey, what happened? I think for a while it went up and then for a while it went down.
Yeah,
Yeah.
it's a totally naturally occurring phenomenon of the market too. I'm sure there's no shenanigans going on behind the scenes.
No,
Did
definitely
anybody
not.
100% normal.
downs?
I think Mike got the downs. Mike, you caught some of the downs, didn't you?
I caught a lot of the downs.
Yeah.
This is not going well.
Oh, we just started recording. Oh, okay, cool. Game face.
Mike's he started me and Mike started a new business. It's called onlypaperhands.com, and it helps you to avoid being a paper-handed Perenich, as they say.
Mm-hmm.
Because if you do sell your position in something, then you have to look at your friend's nudes and describe them in full detail.
Yeah. It's a really good market that we're cornering. It's a huge market, actually.
Yeah, it's been growing at 1,000% month over month.
Here's a little bit of a rundown of what I did. I saw it falling, and I'm like, this isn't good. So I sold a few, and then I thought I'll just buy those back the next day at a lower rate. And while they were down, like right in the morning when the market opened, I put in an order, right? And because I just switched my broker, I put an order at like 130 or something, and my order was for 100 shares.
Uh-oh.
Oh no.
It would have been great because it went from 130 to 180 that day.
Yeah.
But unfortunately, I didn't have 13 grand in my account, so it didn't go through.
Like, how many times do I have to tell you, always have an insane amount of liquid cash in your account?
I think that if I were still on Robinhood, it would have let me do it.
Really?
Yeah, because I'm like in a cash account because I do some scalping and day trading, it won't let me do it. So like I don't use any margin. Speaking of margin, John Paul, you look so lovely tonight. Speaking of margarine, what do you think about what happened today?
Oh,
What happened today?
I was busy doing other stuff. There was fun that like blew up a bank in Switzerland or something.
Yeah, Credit Suisse. Well, there's this guy who was partially responsible, from my understanding, partially responsible for the VW short squeeze. He overextended the margin that he had been using to the tune of like, I don't know, like $8 billion. And then I guess the people who are lending, the margin basically said, hey, you need to, we're not happy with the amount of risk, right? At $100 and on March 22nd, and then March 23rd, it went down to $91. And then it had a little bit of a ride, it stayed there for a little bit, the 23rd, and then 24th, $72. And today it ended at $45. So yeah, it's not good. I'd have to say that's.
I told you not to get a second mortgage and put it all in Viacom.
Yeah,
I told you.
So,
well, look, Sachs and Morgan Stanley sidestepped all that meltdown, and Nomura, the Japanese bank, Nomura and Credit Suisse took the hit, the billions of dollars of losses.
Ouch. So I don't understand what just people, one hedge fund like fucking around like literally fucks over everyone? I don't really understand.
Well,
Yeah.
fortunately, they deregulated the banks,
Oh, good.
and this happened 15 years ago. And it allowed the banks, even though they were FDI insured and had some security from federal government banking laws, they were allowed to do trading. So they would set up these trading departments, and some of the traders would hire hedge funds. And some of the hedge funds are flaky. And so this guy burned through $20 billion. Archegos, $20 billion move to try and flee certain names, dragged these bank stocks down. So their exposure, I mean, it happened years ago at a British bank that was bankrupted by a single trader who lost, he was doing like some sort of naked positions, and which puts you in a position where you can have unlimited losses,
Right.
and more money than the bank actually had. It was billions of dollars in the 90s.
What could go wrong?
So,
Let's call him M. Perenich.
wait,
No,
that's
no.
too obvious.
Where a hedge fund manager goes cray cray.
Dad, did you ever know any guys that did that? That like lost an unlimited amount of money?
Yeah, you can do naked puts,
Did you have any friends that tried to talk you into doing that?
Well, no, I never really dabbled.
So, John Ball. So for like all the idiots out there, like Chris, particularly, what's the difference? What's the difference between a naked put and a clothed put?
Well, I never really participated in the options market, so I couldn't tell you, but that's just sort of a slogan that a naked put is the most dangerous of all stock positions.
Mm.
Like when you're naked in the woods.
Well, I think
pretty
a put
dangerous.
is I started researching options a little bit. A call is when you actually own the stock. Is that right? Or a put is when you.
It's a contract to buy at a higher rate, right? Like you can do a strike.
A put is
call
to
with
buy at
money.
a certain rate.
Yeah,
at a lower rate.
Let's let JP answer.
Is dangerous. So
Okay.
My understanding is that a naked put would be using margin to make a put, and basically borrow money to borrow stock in order to put down a stock. Does that sound right? I don't know. I guess we could all look it up.
Yeah, we don't have time for that.
Dude, who's got time to Google shit? Not this guy.
My favorite thing about this podcast is anytime JP tries to talk and someone breathes too heavily, I can't hear him.
Sorry, the error.
So here's the secondary question. So like you have Credit Suisse and Viacom who took a total dump. Is it a good time to buy those, or is it a bad time to buy those?
Great question.
Viacom, a good stock to own in the first place. I don't know. What's the symbol?
VIAC.
VIG.
What
is it?
What about Viagra.com? Oh, that's something different.
VIAC.
Okay. Oh, it's at 45.
I'm drinking a Bud Light.
Ooh, I was. Seltzer.
Watching its figure.
Ooh.
So,
watching the market recap.
For the year, it's gone from like 25 to 100, and it recently crashed down to 45. I don't know why on earth Viacom would go from $25, $30 to $100 in 3 months.
All the property they own.
I don't
I
know
mean,
what
they own like tons of intellectual property.
so
Right.
what? It wouldn't justify a triple in price.
Do they own like a streaming service? Do they own like Paramount
Yeah.
Plus?
No, they have their own CBS
All access?
bullshit. Yeah.
They were originally CBS Corporation.
I don't know a single person that subscribes to CBS All Access.
Wait,
Yeah.
you don't
Well,
want to
They
what's that
own
stupid nerd show?
CSI? Oh, Big Bang Theory?
Yeah. You
They
don't want to
own-
watch that?
Yeah. my roommate watches it.
Nickelodeon, MTV, Paramount Pictures, BET, All Access, Pluto TV, Simon and Schuster. So
You
they
know.
own
All the up and comers.
I think Pluto TV is actually like blowing up. All my friends watch that.
Chris, you're a WB fan.
Oh,
Don't you
huge.
like watching reruns of Hanging with Mr. Cooper?
Yeah, if I can catch them on UPN, if I could stay up late enough. Yeah,
Well, here's
it's on 11. It's a little late.
can't see it too good.
Oh God, you need to learn how to use a fucking computer. This is so embarrassing. If you were literally just on your computer, zoomed in, you could share your screen.
Well, I don't. You guys got to teach me.
Yeah, John, go over there
Okay.
and just show. Oh, yeah, I'll
Hey.
show you next weekend.
You know the email that you got from Chris that you didn't accept? If you accepted it, there's a link in it that you just click on, and that link brings you here.
Oh, I did on my phone.
Well, you could do it on your computer from your email.
Computer
right.
Darsh.
Good
All right,
idea.
guys. So let's get down to brass tacks since we've already burned half of the show.
Cool. So we can delete
Uh,
that.
Yeah. So I came up with a couple of segments.
Like it's
I thought we could check in on our portfolio, see how John's magic stock formula is going, and then talk about a couple stocks we're excited about. Check in with the old man of the market and see his take on the state of the market. And then talk about our favorite hot topic locations in the mall.
Perfect.
So John, how's your portfolio?
Well, let me share my screen and I'll show you.
Wait, how do you do that? John, make sure that your onlypaperhands.com tab is closed. We don't want a repeat of last week with Perenich.
That's true. If the host didn't disable the participant screen sharing, then I definitely would
Damn
be
you,
able to
host.
share.
Why is it automatically set up like this? If only I could change it very easily.
If only. All right, cool. So I'm down a decent amount.
Holy shit.
no.
4.9. That's I
So
wish it was red though.
well,
Why
this
is it
stuff.
green? Shouldn't it be?
Well, because I'm trying to match the colors, but whatever.
Oh, okay.
So these are my benchmarks. So right now, pretty much if I had just purchased 100% S&P, the VOO, then I would be up 0.37%. If I bought MDY, I'd be down almost 4%. If I bought QQQ, I'd be up a little bit. So
I can taste that 0.3%.
I know, right? I'm actually not doing too bad, except for fucking this.
Misogyny. Told you that was.
It's Madison
Mega
Square.
song.
Well, it's Madison Square Garden's networks, and they are fucking me because they are doing a merger with one of their other sister companies at a fucking loss. Like the sister company's like, this is doing way too good, and we're having way too many fucking losses right now. So let me just merge this and buy it at like 3/4 of the cost.
Oh.
So and everyone's really fucking pissed about that. So that's why I was like, fuck that. But outside of that,
time to buy in more of that, right?
I mean now, yeah, it's dropped this low for a bit. I mean, shit, what's it at now? No, it's tracking. So current price, it's 15.18, and I bought it at 20 at 19.
That reminds me of a little stock I call GameStop.
Yeah. So I mean, now is an okay time to buy, but Yeah, no, that's the one thing that's truly killing me right now.
Hey
If it
John,
wasn't for that,
why did you choose these 7 stocks? Or did you just choose 7 of them?
yeah, I have 8.
Yeah, why did you choose these 8 out of the sea of potentials?
The reason why I chose them is
And
because I
why
did
did you not invest in only paper hands? But that's I
right.
guess that's we'll table that.
So pretty much when I did my research, I was kind of for the magic formula.
You have the
Ultimately, what it
wrong
does.
AMC up there.
That's true.
Oh, and I did restart my AMC Movie Pass, so you're welcome.
Okay, good. I'm glad you did. So pretty much, I got the screener list from the magicformula.com, and I added in the 6-month momentum because I had researched further that the 6-month momentum, the higher the ratio, the better the return there. And so I was trying to go through and see which one's the highest. And then I actually just did kind of some quick Googling of the companies to see if I wanted to invest in them. A lot of these, obviously, AMC, I did not want to invest in because it's just such a viral piece of shit. This company, Endo, looked awful.
Wait, what is
That's the wrong
AMC?
AMC. That's AMC Networks. That's like the
the television
TV
channel. Yeah.
Okay, well, the reason why it's doing that is because probably people bought the wrong one. So
people are like X.
Yeah.
I did like that movie with Vin Diesel.
So the main reason why I chose the ones I did is because I didn't want to consolidate into too many of the same industry in the same sector.
Smart,
And
diversify.
because I didn't want to, I just looked at random ones and it just didn't seem like they were worth it. So that's ultimately how I kind of came up with ABC, which is this pharmaceutical company. BJ's, I chose that just because I shop there, honestly.
You prefer
these other
BJ's over I'm sorry, Costco.
Yes. Yes. Well, Costco wasn't on the list, so that's why I chose these.
Wait, do you really shop at BJ's?
Yeah, because it's cheaper and they actually have decent products. Like Costco, they're
Cheaper
actually
than
not that
Costco?
cheap.
Impossible.
Yeah. No, the Costco is really not that cheap. So
that's because they pay their employees, you selfish fuck.
That's right.
Yeah. I mean, you get a problem because Chris and I both love Costco. So
yeah, dude, you're fucking hiking up the wrong tree, sir.
Yep.
John, what's the symbol for the Madison Square Gardens?
MSGN. But MSGE is what bought them.
You bought it as MSGE?
No. They're getting acquired by Madison Square Gardens Entertainment.
So that's the current symbol. Okay.
That asshole.
Yeah.
So
I made this little chart to kind of see whatever my current purchase price would be. So I did $500 for each individual company, and I am seeing
why'd you do 500 for each individual company?
Because
just like the paper trade.
I'm gonna get about 20 in my portfolio. I'm investing about $10,000, and so that breaks down to $500 each. So just an even horse race all through each one.
Oh, so you don't continuously invest in each one. You just drop a lump sum and then horse race them out.
Drop a lump sum into 5 to 7 every quarter or so, and then after a year, I have my sell by date here. Sell by mid-March or so, and that is
okay. Sorry, continue.
Yep. And so hold it for a year because the whole theory, the whole philosophy behind this is to ride the wave while these companies are doing exponential growth and then sell them off. And
John,
so then
question.
find new ones. Yeah.
So is it my understanding correct that you have 10,000 in liquid refreshments, but you're only investing 2,500 per quarter?
Something like that. Yeah. Anywhere from 5 to 7. Like I got up to 8 holdings this month, but I might only do 5.
Why not just jam it all in at once?
Because that is a terrible idea. Because I can't time the market, and I don't really know when the best time to buy this stuff, and I don't want to do a bunch of due diligence on every single one of these 30 to 50 companies. And so if I kind of space it out, so every quarter, so I'm going to go back to the screener, get a brand new list of companies, and then I'm going to choose 5 to 7 of them from there. And that way I can kind of see who's fallen off, who's been added on, and have a new list to choose from. And that way I can kind of make sure that I'm hitting more winners over time.
Mm-hmm. But aren't you losing compounding interest by not investing cash that you have?
Not necessarily, because I'm not trying to compound. This is as short a term possible investing as I'm comfortable with.
Dad, so what's your take on this?
Well, John's doing what is called momentum investing, which is he's buying things that have been going up at a more rapid rate, appreciating quickly, with the assumption that the train is still going to go up and you need to hop on board. Unfortunately, it's one of the most difficult ways to play the market, because there's a phenomenon known as late for the party. And generally, insider information that pushes these stocks up, and then the uninformed jump in and hit the top, and then they ride all over, to the bottom in the next go round. So momentum investing is very tricky. So
well, what about the like my understanding from my little understanding, I technically have an MBA and I've produced multiple podcasts for years about finance, but I still consider myself quite a moron. My understanding is the greatest benefit of investing is compounding interest. Even if you're not setting the world on fire and investing in Facebook like pre-IPO or whatever, like compounding interest, you'll double your money every 10 years.
7 years.
7 years.
Well, it depends on the rate.
So isn't that a bit of a risk to not?
Applies to interest being earned on CDs at the bank or on bonds that you can reinvest, but it doesn't apply as well to the stock market. Normally, because let's say you buy a nice dividend stock, I don't know, Home Depot with a 2% dividend, or even the S&P 500 with a 2% dividend. They don't actually provide automatic reinvestment. So that dividend just dumps into a money market account. It doesn't more Home Depot stock. So
you can click the button to tell it to buy more stock, though, right?
In Schwab, you can do that, yes.
You have to do it manually.
Well, I always do it.
But, usually the purchase of stocks is either to be done systematically with dollar cost averaging, like every month buy some. So if you have $12,000, you invest $1,000 every month over 12 months. Or you do strategic investing, which, because the market tends to go up 10% and then drop 5% and go up 10 and drop 5 on the drops. Like every time the market goes down 5%, you could be your timer to buy in. Say, and that's what John is trying to do, a little bit of market timing.
But it seems like wouldn't you miss out on so much growth over the next 12 months?
So my kind of reasoning for this is an experiment for me.
Yes.
I'm testing this out and testing out this theory.
And I'm not calling you out, John. I'm just trying to figure out for myself.
No, and so basically I'm doing a dollar cost averaging portfolio as well, and it's doing significantly better right now. But obviously this one I just started a month ago. I wanted to kind of test out this portfolio for 3 to 5 years, because that's what the constraint said in the book. Hey, you might lose some money to begin with, but in about 3 to 5 years, you will hit enough winners to make it more profitable than just investing in the S&P 500. And so
Yeah,
I'm putting that theory to the test.
The 3 years is like the cutoff.
Is the minimum.
Yeah.
Is the bare minimum.
You're fucked until 3 years happen.
Not necessarily. It's just like, don't give up on the formula until you at least try a strategy for at least 3 years. And so I'm willing to throw 10 G's into this to kind of see how this works, kind of get a better understanding of it, see if there are better metrics to kind of do it, and just play around with it and see if this might actually be a good way to make more money than just this kind of slower growth, dollar cost averaging, and doing $1,000 a month or something like that. So I want to try and compare them.
Couldn't you do, just go back to like 2018 to like 2021 and just check those 3 years and like pick some stocks and see if it worked? Like, is my understanding correct? Like, this is an experiment to see if it works before you go like all in on it?
I don't know. I mean, I don't know what I'm going to do when I figure out the results. But
the
whole thing about it for Mike, the whole thing about that line of thought is previous results do not mean future gains.
But so I thought that was the whole purpose of this strategy, is that it always works over a 3-year time frame. Like there's no part of the market's history that you can find 3 years where this strategy will have failed. I've listened to 2 hours of the 3-hour audiobook.
Yeah, no, if you actually look at the charts, there are times when it was down and it was not working.
3 years?
Not 3 years in a row, but for up to 2 years or almost 3 years. But then the whole reason, well, even though it was down, it wasn't down by that much compared to the market.
It was like 1%.
Exactly. And so that's why I feel like it's a fairly safe bet to try and test it out and kind of see. So I want to do that myself, see if there are other metrics that actually make it better, and see if it would be a viable option to grow money a lot quicker so I can retire faster.
See, this is where me and Perenich's recklessness really comes in handy. Because we would do like a 2 month, well, even that might be a lot. Let's say a 1 month due diligence and be like, oh man, I'm up 0.09%. I'm a YOLO everything into this bitch.
Yeah.
Well, yeah, that is true.
I mean, honestly,
John, why don't you just do like why don't you do some paper trading and then see how that goes?
Paper hand.
Because that's boring.
Well, I mean, not really. I mean, it just depends. Like, if you want to like compare 2 different strategies together, like you could do a different strategy with like a paper trading and say, all right, if I had done this a little bit differently, this is how I would have done. Like, I sent a screenshot to John Paul, where I managed $1 million for the day and I was up 15 grand. And I told him, why don't you just leave all your money to me?
So you're up 0.0001%.
No, I made $15,000 in a day. That was a lot of money for me.
I don't know, because it's more exciting to have some skin in the game, I think.
No, I agree.
And I have the capability to do it, and I want to retire faster. So if this does work out, hey, fuck yeah, awesome.
Is there anything else we need to see on this screen, or can you stop sharing it, or what?
Yeah, I can stop sharing. Somehow.
Go ahead, Dad.
Oh, okay. So here's the explanation on the 3 to 5 years.
I don't know how to stop sharing.
When you first bought your house in Landsbrook, how many did you think you'd have to own it before you were assured of a profit to sell it?
Probably, realistically, probably 5 to 10 years.
Okay, so the stock market is exactly the same. So in order to make money in the stock market, you have to think of it like buying a house, hoping that the real estate market rises. Because really the 3 to 5 years is kind of the minimum commitment to be making money in the stock market, no matter how you do it. say, so if you're buying indexes, which John is using as
benchmarks
a measure against what he's doing with the momentum accounts. So that's like another paper trading, account for him. He doesn't really have to fund it yet. 500. You can just, put paper money in it and see how it reacts. But the stock market will leave you with nothing for years. For 3 years is easy for you to have money in the very best companies of the world and not make anything. But when you wait to the 4th year, it just explodes and pays you back for all the time you put in. So
rule of threes.
Yeah, well, in general, if you have a 3 to 5 year period, you can buy any kind of indexes, any kind of baskets of stocks, and you're gonna make some money, unless there's a 10-year recession. And today, the way the Federal Reserve primes the economy by printing money, they don't let these recessions go on forever. So today, the Raymond James analyst, it comes out once a week, and he said the Federal Reserve, what they said last week, implied that they would be pumping money into the economy for the next 2 years minimum, and that investors should expect just a raw index in the stock market to bring you 8 to 10% per year over the next 2 years. And say, so if you're able to dissect that and find which portions of the S&P 500 are going to do even better, and what they're saying is the better sections of that market is the financials, which is all the banks, and consumer discretionary, which is the kind of products people don't buy until they start feeling wealthier. And a couple others, I forget them all, but there's 2 or 3, sections of the stock market that will do even better in this climate of the next couple of years. So it's in the stock market, you got to stay put, especially if you're buying mutual funds or indexes or ETFs. The whole idea is to, not move.
So
what's the
Mike, go ahead.
What's the downside? Like, so part of what I do is I have let's say 80% of my money in long-term stuff, and then probably 20% is
available,
GameStop and AMC, and also for like day trading.
Yeah, well, I think that's good. In order to, retire a little early, you have to take a risk with some money. Say, so few people have enough earned income to fund their 401ks and have an extra brokerage account big enough, consistent enough to really build up enough money. So you have to take a little bit of a gamble and put some of your portfolio, like you're doing, Mike, 20% into flyers, into things that maybe really can go. Now, I don't know which ones to buy, so I buy ARKK.
Yeah, that's been going down.
How many Ks?
A lot.
Yeah. No, it's gone down a lot, but I have a profit in it because I bought it in October and it went up 50% in 2 months, and then it declined 30%. So, and then the other one to buy is QQQJ, which
I bought that when you told me to buy it.
Of technology. So those are flyers, but you don't have to pick the individual stocks, because how on earth are you going to do enough research to find out which one of those is going to go? So you buy this basket of volatile new companies, and then there's
John, is there a version of the magic formula that instead of stocks, you're doing these ETFs?
I don't know. So one of the things that I've kind of found out in my research is once a hedge fund or a mutual fund kind of gets large enough, they don't find the value in these kind of small cap, because like some of the companies that I'm investing in are smaller capitalization, like there may be 50 million or 500 million or something. Like they're not that big companies, and so even if a $1 billion hedge fund invests in them, they would literally own the company and then not be able to sell them or something like that. So like it's not necessarily worth it for them to kind of do a strategy like this, because all the big players, they have these much weirder trajectories than just these kind of small up and coming companies. So there isn't a ETF that I've found that will kind of encapsulate this, and so I'm trying to kind of figure it out myself.
How is there not an ETF that just has these like momentum stocks in it? That seems like
There
an
probably
cool
is,
ETF.
but like not the way that I want to do it.
Yeah.
I don't think so. There are some new ETFs that are called actively managed. So traditionally, an ETF is an index, and they only adjust it every 3 months. But an active managed ETF is one where they actually trade it every day, where they're buying and selling. So there's probably an ETF out there. You could Google it. ETF actively managed momentum. And you'll probably find one that's doing that. So right now I use the ARK family to do that kind of higher risk investing. Now, the thing about small companies, small caps, is they have a lot more risk and they have a lot more profit. So the smaller the company, the greater the volatility, the greater chance for making super money, and the greater chance for losing super money. So
Like
the
Madison Square Gardens.
more predictable their behavior becomes.
Mm-hmm.
So John got the bulk of his money diversified into mutual funds and ETFs and all these stable, more predictable things. And he's taken a chunk of his money to learn momentum trading. And I admire him for doing it. It takes a lot of research, and it takes a lot of analytical structure, which John has done a great job with the spreadsheet. So, he's going to learn a lot. So
yeah, that's what I'm just ultimately going for. Just kind of like what strategies work. Because a lot of podcasts I listen to are saying like value investing just has been in the tank for the last 10 years. And so, yeah, you may be able to find these diamonds in the rough, but they're not really growing that much just because of X, Y, and Z.
Hey, quick question for Perenich. What is value investing?
It's when you invest in value.
Would anyone else like to answer?
Value investing is basically when is a similar way to momentum investing, where you're finding these very, very profitable companies that are undervalued, and so you're ultimately kind of timing the market in a new way. Like JP was saying, the market always kind of goes up 10 and then drops 5%. Yeah. And so you're able to look at their free cash flow, look at their balance sheets, research what they're actually investing in, what their goals are, and find an intrinsic value of what the stock is. Once you have that, then if it ever hits that price, then that's when you would buy, and then you'd hold that stock for a long, long time. And then eventually it would kind of grow. It could be a 10 bagger, 100 bagger, whatever, which means it would grow 10-fold, 100-fold, and make that much more money for you. So that's the general concept of value investing. But this whole stock market has been smart or just like not been moving in those general directions. It seems that a lot of discussion I've heard recently, just those picks have not been picking up the momentum that they have thought they should have.
The value stocks in general tend to be boring.
Yes.
or they were growth stocks that had a sudden bad event happen and they got crushed. So let me give you an example. Apple was at a height of about 135, and back in 2020 it was $75 a share. So Apple goes from 130 to 75, it becomes a value stock. It's a growth stock now, but it's a value stock if the price drops in half. Because the PE ratio drops from 30 to 15. So that's a below the market average price earnings. So value stocks generally have a low PE and a dividend, say, and Apple has a dividend and they're a growth stock now, but a sudden turn of events could turn them into a value stock.
Okay, so PE is kind of the biggest determiner of growth or value.
It's a determinator. Like that, there are multiple.
Probably maybe
factors.
the most important.
That's the most important one. A low PE is going to indicate a value stock.
Yeah.
And there's quicksand that's a part of value investing. You can get what's called a value trap. Something looks really cheap, but it never goes up. And you get stuck.
I have a few of those.
Something that never goes up. Value trap. So there's all potential risks associated with all the different styles of investing.
Hey, we got 5 minutes left, and I'm going to steal them by asking JP if he thinks Tesla can be bigger than Apple.
It already is, I think.
No, it's not.
Wait, so Dad, what's your interpretation of Kathy Wood's valuation of Tesla? Because that seems insane to me.
Well, she is pouring gasoline on her own fire. Okay, so she's hyping the position in that she has in Tesla. See, so she's taken she works for the ARK funds, right?
Yes.
Yeah, okay, so what she's done to bring in capital is she took all of her portfolios and she overloaded them with Tesla. Okay, deliberately to give her portfolio some momentum. And it was a gamble she took last year or the year before. And it paid off because suddenly the ARK family got explosively successful because her portfolio went up super normal because it was overloaded with Tesla. So now trying to save her own ass, she is touting the shit out of Tesla. So
I mean, even outside of that, like the disclosures in
you trust what she's saying about Tesla, in my opinion, because she's got too much Tesla in her portfolio. The temptation to tout something that you own to make it go up.
Right. Yeah, no, I get that. I mean, one thing that I think is interesting as well is I can't remember the name of it, but like their disclosures of like how they're forming the portfolio. They recently changed those from like only owning 10% of a company or one of the biggest holdings should only be 10% is now their biggest holding could be 30%.
Right.
So what are they going to go 30% in these portfolios of Tesla?
Yeah, they will, absolutely. Yeah. At the beginning of the year, all the portfolios, their largest position was Tesla. So it was like, I don't know, 12% or something. And then it went up bigger than that. And I guess they didn't want to sell it. So they just changed the rules.
Okay.
All right. Speed round for the last 2 minutes. What stocks or things are you watching related to the market this week? I'll go first. GameStop and AMC. Next.
I just started buying into Altria Group, MO. They are that cigarette company. They have a holding in some weed companies, some marijuana companies, and they also pay a ridiculously good dividend. So I'm kind of holding them for a bit and see how that works out.
Well, weed's supposed to be federally legal in the next 18, 24 months?
We'll see.
Yeah.
Okay, now John,
Apparently.
You should take a look at the chart of MO for 5 years. It's a value trap.
You think so?
Well, look at the chart. If you go back 5 years, it's been losing money for 5 years. The chart, this is slowly trickling lower and lower.
Yeah.
So, I mean, they have so much in cigarettes and a little bit in marijuana.
I wouldn't invest in anything with cigarettes.
I didn't necessarily want to, but the dividend just looked nice. And so I'm doing a kind of dollar cost averaging into it to kind of see what it looks like.
John, I thought you were a conscious capitalist. This comes as very surprising.
Now, the other thing you need to look at, John, is the cover ratio on the dividend. It's paying 6.5%. You have to find out if they have enough earnings to continue to pay the dividend. Sometimes big monster companies aren't even earning enough money to pay that dividend.
Right.
And then if they're forced to cut the dividend, the stock plummets.
Right.
So be careful about that. It's called the coverage ratio.
Yes. No, I've looked into their financials and they have enough to cover it.
All right. Well, it is time for us to call. Mike, I'm going to give you a brief extra time of point.
No, I'm just playing some crypto and just seeing what DraftKings does. I guess they're having a merger with WWE. So,
well, one thing I'm kind of hoping for as well on top of Mike is if New York allows sports betting, then Madison Square Gardens will hopefully go back up again.
There's also like a gold nugget. I forget the name of it. It's like GONG, and that's supposed to be pretty valuable stock if they allow more online betting.
Yeah.
Nice. All right. Well, that's all the time we got today. Unless JP, you watching something this week?
This week? No, I'm just playing real estate.
Nice. All right. Well, thanks everyone for listening or watching or doing some combination of the two. We'll see you next week on Stonk Tonk. Don't forget to check out our sponsor, Viacom and OnlyPaperhands.com.
Thanks for tuning in.